Today, we're covering 15 essential things every beginner needs to know about the stock market. Investing might seem complicated, but understanding these key concepts will help you feel more confident and make smarter financial decisions. Let's dive in. This is Wealthlocity. Here you create, protect, and grow your wealth fast. The stock market is a marketplace where shares of publicly traded companies are bought and sold. When you buy a share, you're buying a small ownership stake in that company. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ, making it easy for investors to trade shares. Understanding the stock market's purpose is crucial. It's a way for companies to raise money and for investors to grow wealth by supporting businesses. By participating, you're essentially betting on the success of companies, which can help you grow your savings and be part of the economy's larger growth. The stock market has historically been one of the best ways to grow wealth over time. Average returns over the long term tend to be higher than other investments, like bonds or savings accounts, which barely keep up with inflation. Investing lets your money work for you. While keeping cash in a savings account is safe, it won't grow as fast. The stock market offers opportunities to increase your wealth significantly, helping you achieve long-term goals like retirement, buying a home, or building an emergency fund. Investing in stocks comes with risk. The value of stocks can rise and fall based on factors like economic conditions, market sentiment, and company performance. While there's potential for high returns, there's also a risk of losing money. Understanding risk and reward helps set realistic expectations. Stocks may offer the highest returns over time, but they can be volatile in the short term. Recognizing this helps you make decisions that align with your risk tolerance and financial goals. There are several types of stocks you can invest in. Common stocks give you ownership and voting rights in a company. Preferred stocks offer fixed dividends, but usually no voting rights. Growth stocks focus on capital appreciation, typically in companies expected to grow quickly. Dividend stocks provide regular income from profits. Choosing the right type of stock helps align with your goals. Growth stocks may offer higher potential returns, but dividend stocks provide stability and regular income. Preferred stocks may be less volatile, ideal for conservative investors. Understanding these distinctions is key to building a well-rounded portfolio. Stock market indexes. Stock market indexes track the performance of groups of stocks. The S&P 500 includes 500 of the largest U.S. companies, giving a snapshot of the market. The Dow Jones Industrial Average follows 30 major companies, while the NASDAQ Composite is tech-heavy. Indexes are a useful benchmark to measure the market's overall performance. By investing in index funds or ETFs that track these indexes, beginners can gain broad exposure to the market without picking individual stocks, making diversification easier. The power of compounding. Compounding is when your earnings start generating their own earnings. For example, if you invest $1,000 and it grows by 10% annually, it becomes $1,100 in the first year. In the second year, you earn 10% on $1,100, not just the original $1,000. Compounding can lead to exponential growth over time, especially if you reinvest dividends or earnings. This makes starting early, even with small amounts, incredibly powerful. The longer your money compounds, the greater your returns can become. Diversification means spreading investments across different sectors, asset types, or regions. Instead of putting all your money in one stock, you can spread it across tech, healthcare, energy, and other sectors. Diversification reduces risk. If one stock or sector performs poorly, others might do well, balancing out your losses. This creates more stable returns and helps protect your portfolio from market downturns. Think of it as not putting all your eggs in one basket. Long-term investing means holding on to stocks for years or decades, allowing your investments to grow and compound. Short-term investing or trading involves buying and selling frequently to profit from price fluctuations. Long-term investing generally carries less risk and allows you to ride out market volatility. Trading can be profitable but is much riskier and time-intensive, often requiring knowledge and discipline. For beginners, a long-term approach is usually safer and less stressful. To buy stocks, you'll need a brokerage account. Most online brokerages let you set up an account easily. After funding your account, you can search for a stock by its ticker symbol, decide how many shares you want, and place an order. Learning how to buy stocks is the first step in becoming an investor. Different brokers offer different fees, features, and tools, so it's essential to pick one that aligns with your needs, especially if you're a beginner. Investing comes with costs, such as trading fees, management fees for mutual funds or ETFs, and annual account maintenance fees. Even small fees can add up over time, eating into your returns. Lower fees mean more of your money stays invested. Look for brokers and funds with low expense ratios, especially if you plan to invest long-term. For example, even a 1% fee can reduce your returns by thousands over decades. Dividends are payments companies make to shareholders, usually from profits. Companies that pay dividends are often stable and established, making dividend stocks popular for income-seeking investors. Dividend stocks can provide a reliable source of passive income, which can be reinvested to buy more shares and compound your returns. They add stability to your portfolio, offering returns even during periods of market volatility. Investing based on emotions like fear during a market downturn or greed during a rally can lead to poor decisions. For example, panic selling during a dip locks in losses, while buying due to FOMO or fear of missing out can lead to overpaying. Avoiding emotional investing is crucial for long-term success. Having a strategy and staying disciplined prevents impulsive decisions that could harm your portfolio. Investing based on a plan rather than emotions is a skill every beginner should develop. The stock market is affected by economic factors like interest rates, inflation, unemployment, and GDP growth. For example, rising interest rates can make borrowing more expensive, which can affect company profits and stock prices. Understanding economic factors helps you anticipate how the market might react to events. For example, during high inflation, sectors like energy or consumer staples might perform better, as people still need essentials. This knowledge can guide your investment decisions. Dollar cost averaging is a strategy where you invest a fixed amount regularly, regardless of the stock's price. This approach allows you to buy more shares when prices are low and fewer when prices are high, averaging out your purchase cost over time. Dollar cost averaging removes the pressure of timing the market, which can be stressful and risky. For beginners, it's a great way to build a disciplined investment habit and reduce the impact of short-term volatility. Investing without a plan can lead to inconsistent choices and emotional decisions. A solid plan includes your financial goals, risk tolerance, time horizon, and a strategy for how much and how often you'll invest. Having a plan keeps you focused on your long-term objectives, helping you avoid impulsive decisions that could derail your progress. When the market gets bumpy, your plan serves as a roadmap, guiding you back to your goals and helping you stay disciplined. And there you have it. 15 essential things every beginner needs to know about the stock market. Learning these basics will give you a solid foundation and help you make informed investment decisions. If you found this video helpful, please like, subscribe, and share it with anyone interested in learning about investing. Thanks for watching, and happy investing!